But no, you can't. You can't have a government like this without an income tax. But we don't want a government like this. This is not the kind of government that was designed by our founders of the country. It's not what was written in the Constitution. We've only had an income tax since 1913. But if you want a welfare state, and if you want to police the world and pay for the defense of Japan and Germany, send foreign aid to the Soviet Union, you not only need the income tax, you need the Federal Reserve to print up the money when the deficit is accumulated. So we think the government should be much smaller. If government is small, then you don't need an income tax.
Buckle your seatbelt. It's time for another episode of the Prepper Recon Podcast. Whether your plan is to bug out or bug in, CampingSurvival.com has all of your preparedness needs, including fish antibiotics, long-term storage food, water filters, bug-out bags, and first aid kits. Use coupon code PrepperRecon for 5% off your entire order at CampingSurvival.com. While you're at PrepperRecon.com, stop by the Prepper Recon supply store. We've got a great selection of Molly compression packs, hydration kits, and our new concealed carry tactical slings. All the packs and slings come with your choice of patch to let liberals know how you feel. We have some very cool Mulan Lab patches, Come and Take It patches, Sheepdog, Zombie Response Team, and matching U.S. flag patches. Of course, we still have our fully stocked Molly-compatible individual first aid kits as well. Just click the Store tab at the top of the PrepperRecon.com homepage. Today's guest is John Rubino. John runs DollarCollapse.com and wrote the book which predicted the housing bubble called The Collapse of the Dollar and How to Profit from It. He released a new book with co-author James Turk called The Money Bubble. If it turns out to be as prescient as the last book, you literally can't afford to miss the information inside. John, welcome back on the show.
Thanks for having me back, Mark. Great to be here.
Oh, absolutely. It's always a pleasure to have you on. So the BRICS nations have decided to base the BRICS Bank in Shanghai. What does that mean for the dollar?
Well, it's a threat to the dollar, but it's a long-term threat. Basically, the emerging nations of the world are not happy with the U.S., as they should not be, because we're basically flooding the world with dollars, and that causes asset bubbles in emerging countries, and then when the money flows back out, it causes crashes. And so they don't have control over their own monetary policy. It's all being made for them by the Fed, and the Fed's not doing a very good job from their point of view. So they're beginning to take steps to lessen their dependence on the dollar. And one way they're approaching that is by starting basically what they call it a BRICS bank. It's going to be a version of the International Monetary Fund that will be able to lend money to BRICS countries when they get into financial difficulties and kind of ease the transition. And it'll be transacted in BRICS country currencies. In other words, rubles or yuan or rupee or whatever. And that will allow them to basically bypass the dollar and in that way lessen their dependence on the Fed. And so it'll take a few years to get something like that up and running. But when it happens, it will make the dollar less necessary around the world. Because right now, everybody has to have dollars if they want to buy and sell oil or pretty much anything else. You transact in dollars and then back into your own currencies at the end of the transaction. But the rising powers of the world are seeing that as less and less necessary. And so they're beginning to cut, besides something like the BRIC Bank, they're cutting deals bilaterally where China and Russia, for instance, decide to transact in their own currencies for energy, for instance. And that kind of thing is spreading around the world where they do currency swaps. You give me some of your currency, I'll give you some of mine. And then when we buy and sell things with each other, we'll just use those currencies. So over time, this is going to erode the dominance of the dollar in global trade. And as that picks up speed, right now most of the world's central banks and most of the big trading entities have to hold maybe 60% of their ready cash in dollars. Well, they're going to need fewer and fewer dollars as time goes on, so they're going to lower the percentage of dollars in their reserves to 30, 20%, whatever, depending on how far this goes. And that means they're going to have to sell dollars as part of that process. And so that's going to put downward pressure on the dollar. And we want that to an extent. We want a lower dollar because it gives us a trade advantage here in the U.S. But if it really gets going, it's deadly for a major currency, especially a reserve currency. Because once people realize they don't need dollars, they can get by without dollars, they will begin to dump their dollars. And they'll all head for the exits at once, and we'll get what Austrian economists call a crack-up boom, in which people figure out that the dollar is being systematically devalued by explicit government policy, and that it's going to go on for a long time. So nobody's going to want to hold dollars. As soon as you get your paycheck, you're going to swap it into real assets. You know, you'll buy some farmland, you'll buy some gold coins, whatever. And the same thing will happen for larger trading entities like international companies and countries. And so pressure on the dollar will get more and more intense until it just evaporates. You know, this has happened dozens of times throughout financial history. And it always ends the same way, with the currency becoming a shadow of its former self. And so we're creating the conditions in which something like that is going to happen to the dollar. But we can't say when it's going to happen. You know, the timing is what's questionable, but the policies that are now being put in place and the reaction around the world to our policies are pretty clear. You know, we're heading in that direction. And so whether it happens next year or 5 years from now is completely unpredictable. But the fact that it's going to happen, that the dollar is going to lose its single reserve currency status and become just one of many, and then possibly become an obsolete currency completely, that's baked in the cake. And so it's all a matter of timing now, not if, but when.
And you mentioned that we'll be cashing our paychecks as quick as we get it and getting it into tangible assets. Now, I believe it was the stories that I've heard about the collapse in Argentina in 2001, where the wives of the factory workers would actually go to the factory where their husband worked, and they were getting paid twice a day, and the wives would be there to meet them at lunchtime so they could go spend the money before it was devalued. And then at the end of the day, and they were actually getting paid twice a day, and they were running out and spending it as quick as they could before it was devalued.
Exactly. That's how that goes. And so in Argentina's case, I think they're mostly buying the necessities of life. They're going out and buying groceries because they don't want the grocery price to go up between now and 2 days from now or whatever. They're buying whatever they can. And for you and me and our peers here, we'll do some of that, but we'll also buy gold and silver coins, or we'll invest in the equities of a company that owns real assets. We'll buy some oil stocks or a gold miner or something like that as a way to use our dollars to preserve value, because you can't just let your dollars sit in a bank account if you feel like the currency is going to be inflated away. Because your bank account right now, what does a bank account yield? 0.5%, give or take.
And after all of the fees, it's probably negative.
Probably, yeah. And then you have the risk of bail-ins, where if your bank gets into trouble, they take 10% of your account. So you don't want to do that in this kind of an environment. So what you'll do is you'll take your ready cash, and you'll invest it in things that will probably hold up in a currency crisis. And that's generally real assets. You want things that governments can't make more of on an electronic printing press. And the things they can't make more of are farmland and oil wells and gold and silver. You have to dig precious metals out of the ground, and that's laborious and risky. And so historically, we've seen the supply of gold and silver go up about 2% a year. And that's pretty much consistent with the growth in human population, which means that gold and silver tend to stay about as plentiful per capita as they've always been over time. And that's a recipe for price stability. They're going to hold their purchasing power over time because their supply is going to be stable over time. And so compare that to a fiat currency where they can create as much as they want to, and any time there's an election coming up or anybody gets in, big bank gets into trouble or there's a war, first thing they do is flood the system with new currency. And so the supply of paper currency and the electronic versions of paper currency are going through the roof now. They're rising at 6, 7, 8% a year, while gold and silver are rising at 2% a year in terms of supply. And so the gap between those two lines has become gargantuan. And So James Turk, my co-author on our new book, The Money Bubble, has done some calculations to equate the amount of gold that's in the world with the amount of paper currency that's in the world. And it's come to the conclusion that gold should be about $10,000 an ounce. So at any price less than that, it makes sense for you to convert your dollars into gold coins or gold mining stocks or whatever, because you can assume that the supply and demand imbalance between paper currency and precious metals will work in favor of precious metals just because we've allowed the imbalance to become so huge. So, and same thing with other real assets. That's just the conclusion that people are going to come to, and it's going to manifest as inflation. We will be buying these things at higher and higher prices because we'll be losing faith in the currency at an accelerating rate. So it'll look like prices are going up. But really what's happening is the value of the currency is going down. In other words, the thing we use to measure food prices or oil wells or gold and silver coins, that is changing in a negative way. So it's making the value of an oil well go up in dollar terms, while the oil well didn't change. It's still what it was, and it's still as valuable as it was 10 years ago or whatever, but because the dollar is less valuable, the price of the oil well, the market value of it, is way up. So we think of that as inflation. That's how it'll manifest, but it's not, strictly speaking, rising prices as much as it is a declining currency. And so it's really important to make that distinction because that way you understand what's really happening. It's not that there's a huge increase in legitimate demand for food and oil and precious metals. It's that we're losing faith in the currency. And once that gets going, once people get that thought embedded in their minds, then there's no turning back for the currency because it takes a really long time to change someone's mind. And once they conclude something, it takes a really long time to change it back. So once you cause people to lose faith in the currency, it's very, very hard to get them back. In the 1970s, we went through a mini version of this when people started to lose faith in the dollar and prices started to spike and inflation or interest rates went through the roof. And what we had to do to get the dollar back to in people's minds to being a legitimate currency was we had to raise interest rates to double-digit levels and engineer a massive recession. It was the worst 2-year recession since the Depression at the time, although we've had worse ones since. But it was a really, really traumatic event, and that's what it took to restore faith in the dollar. Well, we couldn't do that now because back then we really didn't owe that much money. The debts in the U.S. system and in the world at large just weren't that high. So we could raise interest rates without causing, debt that would have to be rolled over at higher and higher rates and bankrupting everybody. That wasn't a problem back then, but now it would be. So if we tried to, or if we shake the faith of the global financial markets in the dollar and then try to restore the faith in the dollar by raising interest rates, that would cause a catastrophe of epic proportions because the world's governments have all borrowed huge amounts of money very short term and they have to roll their debts over, and individuals have taken out adjustable rate mortgages, and the leveraged speculating community has placed hundreds of trillions of dollars of bets on the movement of interest rates. So all of those things would be disadvantaged by rising interest rates. And so you'd see, Japan's budget deficit go through the roof, and the U.S. having to, if our interest rates just go back to normal levels, which is to say about 6% on 10-year treasuries, our interest costs in the U.S. for the U.S. government would go up to $1 trillion a year. Our budget deficit would just explode again. So we can't do that anymore. And so we risk in aggressively liquefying the system and inflating away the value of the dollar to gain a trade advantage. We risk tipping the system over into a phase where nobody trusts the dollar, and we don't have any tools left for restoring their trust. And that's the conditions that we're creating right now. And once it gets going, there won't be any solution. And then it'll really get going, because the real tipping point is when people figure out that the government can't stop it. That the government has used up all its ammunition over the past couple of decades just trying to keep a dysfunctional system going. And once the dysfunctional system really starts to malfunction, they have nothing left. And that's the end game. That's when people just wash their hands of the dollar. And when it happens, it'll happen very fast. There's the old quote from Hemingway about a friend of his who went bankrupt gradually at first and then all at once. And that's the way it'll happen for us. We'll have a descent into a currency crisis and then a very quick currency crisis that lasts 6 months or a year, in which time the dollar just evaporates as a legitimate currency. And again, who knows when it happens, but it might be sooner rather than later based on current trends.
And for people that think that $10,000 gold is crazy talk, that's only 7.7 times higher than what it is right now. Whereas if you look at the ride from the 70s, when gold was $35 an ounce, to now where it's $1,300 an ounce, that's 37 times higher than what it was in the 70s. If we repeated that run and actually went up 37 times from here over the next 40 years, that'd put us at about $48,000 an ounce.
Yeah.
And that's just with the current, just repeating the same trend that we've had over the past 40 years for the next 40 years.
Yeah. And big market moves tend to have a parabolic phase right at the end where you get this blow off, like tech stocks in 2000, beginning of 2000, they were already grossly overvalued. And yet they doubled again in the first half of 2000 because that's just the nature of markets. So many people who aren't paying attention finally get it right at the end, right when they shouldn't be getting it. And they pour in, and that spikes the market. So it's completely possible, as you said, Mark, that we get a bigger move than from 1,300 to 10,000 in gold, just because the market panics at the end. So maybe it goes from here to 5,000 or 6,000, which is completely consistent with the amount of paper currency that's out there. And then everybody panics. They can't get their hands on gold at almost any price, and they're willing to pay whatever it takes. And so you see this spike in a very short time up to some ridiculous number. And because that's the way markets go, it wouldn't be that big of a surprise if it happened to gold and silver. And at that point, there's a point at which gold and silver become raging sells, where you really want to dump them because they're so out of balance with the amount of fiat currency in the world. And that'll be fun to see, at least for us, for people who are taking those steps now and who own some gold and silver, it'll be, once in a lifetime chance to make some serious money. But for everybody else, it's going to be incredibly painful and incredibly stressful. And so you wouldn't wish the next 10 years on your worst enemy if they're unprepared for it. And I'm afraid a lot of our friends and family are unprepared.
Now, back to the BRICS Bank. You spoke that they'll be transacting their trade between nations in currencies of the member nations. Do you anticipate that they would try to come up with a basket currency to try to compete against the IMF's SDRs?
Yeah, it's one possibility. They could use the yuan, for instance, China's currency, as the bedrock of some new currency that has components of rubles and rupee and other Asian and Latin American currencies, and then back it with gold, because at least in Asia, they're accumulating huge amounts of gold. India and China are buying just about all the gold that's being produced by the world's gold mines right now. So they've already accumulated quite a bit, more than enough to back a currency that is used by 5 or 6 emerging markets with gold, and make it a rock solid, completely legitimate currency that would be very attractive compared to an unbacked dollar or a euro that is facing all kinds of demographic and structural problems in Europe. So yeah, that's one possibility. It's an aggressive one, though, because were they to do that, and were that currency to become accepted as the world's reserve currency, that means that currency would go up in value. And a really strong currency is a good thing on the one hand, because it lets you buy assets all over the world very cheaply, because you've got high-powered money, but it makes it harder to sell to the rest of the world. So that's the kind of thing that they wouldn't do lightly. They would kind of tiptoe into something like that and do it as a part of the end game, in which the dollar and the euro and the yen are already pretty weak, and they're already falling into disrepute. And then the BRICS countries come up with some gold-backed, yuan-based currency of their own that looks great compared to these radically weaker other currencies. But in the meantime, they've got their export industries that they have to deal with. If they were going to do something where they set up a currency that doubles in value relative to the dollar and the euro, then they would lose a lot of business. And so they have to think about that before they act. But at some point, a rock-solid currency will probably become worth it for them. And so we might see it happen. Again, timing, not this year, not next year, but somewhere down the road, that could be the future of the global monetary system.
In other encouraging news for the dollar, the CEO of French oil giant Total said he doesn't think that it makes sense to settle oil in dollars. Didn't Saddam Hussein say something to that effect once? And do you think Total should worry about the U.S. military-industrial complex coming over there and giving them a lesson in democracy?
Well, it does seem like anytime somebody starts talking like that, something bad happens to them, And I would think that it wouldn't be a military thing in Total's case, but it might be an NSA kind of thing where they start hacking the oil companies' systems and causing trouble in that way as a way to punish them and letting them know who did it. Because the revelations that have come out since Edward Snowden began leaking the documents that he took from the NSA show that we haven't been spying on just terrorist targets, that we've been spying on other countries' major energy companies, for instance. We aggressively penetrated Brazil's main oil company, for instance. And so there's no reason to think that we wouldn't be trying to do the same thing with big European energy companies as part of a process of trying to gain some kind of competitive advantage by knowing what these guys are up to and then being able to bargain with them with full knowledge of their positions in whatever the negotiations are involving. So it's just one step beyond surveillance to sabotage. You could get into a major company's systems and mess with their, corrupt their data or in some way affect their oil refineries operation or whatever. And so if we're going to punish somebody for smarting off like that to us, then that would be the way we would do it now. That's the modern way of slapping down a foreign entity that gets too big for itself. And so, based on all the stuff we're seeing about what the U.S. has been up to lately, I wouldn't put it past us. We are well on our way to a police state, and we're imposing our will on the rest of the world, and we're doing it surreptitiously. Well, we're doing it overtly in a lot of cases, but we're also doing it behind the scenes via the ability of the NSA to basically eavesdrop on anybody. We've got logs of everybody's phone calls right now, and presumably we're using it in negotiations. The amount of blackmail that's going on in the world right now and sabotage is probably far greater than we know about, and hopefully some other leaker is going to come along and let us know what we're doing. But right now we're creating the conditions again for a police state in which Big Brother is watching everything we do and is more than willing to punish us for stepping out of line.
It's time for a quick break, and we'll be right back. The dollar's lost over 90% of its purchasing power since 1971. Silver, on the other hand, has proved to be a very stable form of wealth preservation over the years. And where do you buy silver? Silver.com, of course. Silver.com offers fantastic prices on silver and gold. Check out Silver.com today. The Fed has actually slashed quantitative easing significantly over the past few months, and some folks anticipate that it could end completely as early as October. That's pulling $1 trillion a year out of the economy. How is the interest rate not skyrocketing if the government isn't buying its own debt anymore?
Well, so far, quantitative easing has been a farce. In theory, if we stop dumping, $85 trillion a month into the economy, that's tightening. That would be slowing down the economy. However, as we've been doing that, as we've been buying fewer and fewer treasury bonds, other countries have been picking up the slack. For instance, at first, Belgium of all places, bought U.S. Treasuries almost dollar for dollar to make up for U.S. tapering. And lately, China has been a really aggressive buyer of Treasuries. So coincidence, maybe? I don't know. Or it could be a deal that's been cut out there in which some other countries agree to help us manage the transition away from aggressive ease in the U.S. by flooding the system from different directions with currency, and in that way minimize the impact of this kind of thing. So I don't know. If those guys stop, the other countries stop buying treasuries, and we scale back our QE completely and just stop buying treasuries, then you would think if that's the reason interest rates are so low, that we've been buying back treasuries and dumping huge amounts of newly created currency into the system, then you would think interest rates would go back up because we don't have the artificial pressure on interest rates anymore. And so that's how we'll tell if QE is actually over, if tapering is really happening. You'll see interest rates start to go up. But of course, the system is so highly leveraged and there's so much short-term debt out there and variable rate debt that interest rates can't go up without blowing up the balance sheets and the income statements of half the world. So we're really in a box right now, globally, in which if we keep interest rates artificially low, we risk asset bubbles and instability and rising inflation, which we've got now. You know, food prices are way up. We're seeing bubbly behavior in London penthouses and fine art and in several different major equity markets around the world. And so we can't keep pumping money into the system if we don't want those bubbles to expand to the point where they're destabilizing. But if we stop and interest rates go back up, that's destabilizing. So that it's not really clear what the solution is for things like this. You know, when you get so far down a certain road, you reach a point where there aren't any good solutions, you know, and that's where we are. We basically can have a really aggressive currency devaluation around the world, which would manifest as rising inflation and all the instability that comes with that. Or we could get rid of a lot of that debt through default, and then we could have a worldwide capital D depression. And there isn't really another option. You know, those are the only two things we can do at this point because we owe so much money. So much of it is short term. It's got to be rolled over. And we've been pumping huge amounts of money into the system for such a long time that we have to stop. So I don't know what the answer is. And I don't think anybody really does either. I think these guys they're trying to get through the next few months at any given point in the process. You know, they've got an election coming up, they need to get through that, or their term in office is up at a certain time and they need to retire with high status instead of being discredited. And that's their time frame. So they're doing whatever it takes to get through these short-term periods in which their own self-interest is at stake. And they're not thinking any further ahead than that. So I think that at some point it becomes obvious to everybody that we're out of fixes and the government isn't omnipotent and we can't just come up with some new policy that fixes the old policy mistakes anymore, you know, and when it happens, things will fall apart. And I don't know when it'll be, but I think that there are so many catalysts out there, you know, so many things that can shake the confidence of the global financial system. You know, we haven't talked geopolitics yet, but there's a lot of messes out there. You know, Israel and the Palestinians have flared up, and Iraq is in the process of being conquered by Islamic militants, and Syria is in a massive civil war, and the Ukraine, who knows what's going on in the Ukraine? You know, this we don't even actually know who started it or who's keeping it going, you know? And all of these things could individually or in combination cause a crisis that becomes financial. And so we could see everything unravel in the short run when one of these things flares up and pulls some of the big powers into it, and nobody wants to hold equities or government bonds in a world where, you know, the U.S. and Russia might be shooting at each other. You know, this is the kind of thing that will terrify complacent financial markets, and it's becoming more and more possible now, just as we drift into these crazy situations. So I don't know. and the thing is, this sounds so depressing and so bleak, but it's actually a really optimistic investment thesis. The big crises create huge opportunities. And if we time it right, and if we pick the right strategies going forward, this can be the 3 years or 5 years in which we make more money than we've ever made before in our lives and ever will again. This could be our chance to be big winners. So if we have some capital to play with, while the macro scene is very dark and very chaotic, our personal situation is actually kind of optimistic because it's becoming more and more clear what's going to win and what's going to lose in terms of assets out there. And so we just have to time our entry into these markets well enough so that we aren't hurt if we're slightly early, and then we get to ride the big move when it comes.
Now, 2014 first quarter GDP was negative 2.9%. Of course, that's rounded up from negative 2.96. I guess if you work for the government in government speak, that makes sense. That's how you round up, is closer to zero would be up if it's negative. So 2.9%, we'll call it. Do you think that was from tapering, or was that really because of the snow?
Well, that was a kitchen sink number. They basically they knew it was going to be weak, and so they just tossed every kind of correction that they could into it. They originally had the new healthcare law adding quite a bit to GDP in the first quarter. Well, they took all that out, and so now its impact was zero, and that made the first quarter look worse than it would have. So the question is, do they add all that back into the second quarter and we get some big offsetting pop that makes everyone forget about the first quarter? Or is the second quarter also going to be surprisingly weak? And because the government has so much control over these numbers, there's a pretty good chance that they engineer a pleasant surprise. But the fact is, the U.S. economy is not really growing the way it should, given interest rates, given 0% interest rates and the amount of money that the federal government has been pumping into the system. We should be in the middle of a raging boom right now. Our biggest problem should be how to slow this thing down so that we don't just spin out of control. And instead, we've got housing prices going down, home sales going down, new home construction down. So the housing market, which is a very big part of the Main Street economy, actually declining right now. And the rest of the economy is not growing dramatically. We've got a few sectors where things are increasing, like the service sector is up a little bit for what that's worth, and commercial construction is up a little bit, but generally, and manufacturing is up slightly, but not ragingly. And so things aren't growing. Oh, and the household net worth is dropping dramatically. People just aren't as rich as they used to be in real terms. So families aren't feeling like they can spend a lot of extra money right now, and they're not. Consumer spending is up, but consumer debt is up even more, which means we're borrowing money to pay for necessities right now. So anyhow, you add it all up and the economy doesn't look nearly as strong as it should be given zero interest rates and all the rest. So probably what happens for the rest of the year is that the economy disappoints to an extent, and it doesn't feel like it's hitting escape velocity so that the government can just pull back and let it grow on its own. And we risk having a major financial correction because people start to realize that stocks are kind of priced for perfection and the world isn't perfect, and so they start selling and taking their profits, and it turns into a 30% bear market, okay? And that spooks the federal government into some new version of QE going forward. They'll call it something else, and different people might be doing it around the world, but there will be some kind of big increase in money creation and general liquefaction of the financial system again. And so we'll kind of be right back where we started 2 or 3 years ago, except we'll have taken on 10 or 20 or $30 trillion of new debt, depending on how you calculate debt. And so we'll be even in worse shape with basically the same tools, which didn't work well last time. And that might be the point where people figure out, oh, this is what they did in 2011. And now they have to do it again? What? Didn't it work? So why should we think it's going to work this time if it didn't work last time? And that might be the point where people start to lose faith in our ability to manage the financial markets. And then everything falls apart.
Now, gold and silver prices have been pretty flat lately, but now the U.S. Mint Silver Eagle sales are on track for another record year. They're at 25.8 million ounces so far for 2014. That's up about 3 million over this time last year for U.S. Mint Silver Eagle sales. Are Americans waking up and buying silver instead of flat screens and venti frozen mocha lattes?
Well, to an extent, but not nearly as much as they're going to at some point. Because right now, silver and gold demand are pretty good for different reasons. Silver's cheap relative to gold, so individuals are buying silver coins. Gold is cheap relative to the amount of fiat currency in the world, so other countries' governments are sucking up a lot of the gold in the world. And other country citizens who understand the dynamic. In India and China, people see gold as a really important, viable form of savings. And so they tend to buy gold when they get money, and as they get richer, they're buying more and more gold. So yeah, there's demand coming from different places. And I think wise Americans are buying silver at these low prices. And I think at some point that will create a supply imbalance because silver in particular is becoming a more and more popular industrial metal. The solar power industry 2 or 3 years ago used hardly any silver, but there's a little bit in each solar panel. And now as solar takes off, as it gets cheap enough to compete head to head with energy that's created by a distant coal-fired power plant and shipped to your house. Your rooftop solar panels are now cheap enough to compete in that market. And so people are slapping up solar panels everywhere. And that means more and more silver demand. So in a market that was already tight, you're seeing another 50 million ounces a year, going to be 100 million ounces a year in the not too distant future, taken off the market. And so let investment demand start to increase into this already tight situation, and you'll see silver prices go up dramatically. So that, in that sense, silver has a lot more upside than gold because it's much thinner, and the silver that is used in industrial applications generally isn't recycled; it just goes away. So silver is being taken off the market, whereas gold is used as money. It's bought and stored. So all the gold that's ever been found, just about, is still out there, sitting in vaults and safe deposit boxes and jewelry boxes. Whereas most of the silver that's been discovered throughout human history is gone now. It's been used in industrial applications and then just chucked. So it's completely possible that the supply of silver at some point in the future will be so minuscule compared to the demand for it that you'll have to have a much, much higher price. $50 to $100 an ounce is easy to see from here. And if gold is going to do the $10,000 an ounce thing, then you could easily see silver go to $500 an ounce, because there's a historical ratio between gold and silver that has ranged from more or less 15 ounces of silver to 1 ounce of gold back in the days when both were money, to up to 100 ounces of silver per ounce of gold at the peak of the disparity between gold and silver in the last few years. And now it's down to, I think, 60 or 70. But if it were to go back to something like its historic ratio, back to around 15, then you'd see silver just go through the roof. So it would outperform gold on the way up. So as gold goes up, silver will go up twice as fast. And that's one scenario that I think is completely possible. So that those silver coins in your safe deposit box become dramatically more valuable over time as all of this plays out. That's one of the investments that the average person will find within their reach. You can go buy a few silver coins for a few $100s. and then do that again a couple of months from now, and then a couple of months after that, and just let it keep going. Keep on buying a little bit at a time when you have some spare cash, and eventually it builds up. And then as those coins get more and more valuable, you end up with quite a bit of money there. And it didn't really hurt to take those positions because you were just spending a few bucks at a time. So that's a really good strategy for the average person to insulate themselves from a currency crisis.
And if silver just went back to that 20-to-1 ratio right now without gold even moving, it would go to $65 an ounce.
Yes. Yeah. So we need something to catalyze that, though. There has to be a reason for people to favor silver over gold in the first place. And we aren't seeing that yet. But once silver starts going up a little faster than gold and it becomes noticeable, then you see all the the ratio analysis come out of the woodwork. And that will be something that you can, take this trend and justify it with, and justify its continuation. And so then it becomes easier and easier to buy silver at, 40-to-1 with gold, and then 30-to-1, because you still haven't gotten to the 15 or 20 historical level yet, so it still looks undervalued from this one historical indicator. And that's when that'll come into play. And when it does, it could be very quick. And then it could overshoot. Well, the way bull markets tend to work is they'll go to fair value and then keep on going because you've got all the latecomers who ignored it and ignored it and ignored it, and then finally can't resist the easy money anymore, and they pile in. So silver could go to 10-to-1 with gold, because that's basically the ratio of what's being taken out of the ground right now. Silver mines are producing about 10 times as much silver as gold mines are producing gold. So we could legitimately go to a ratio that matches the current mining output. And were we to do that, and it was 10-to-1, and gold was $10,000 an ounce, then it would be $1,000 an ounce for silver. So it's fun when you start running these numbers, isn't it?
That's real fun. Yeah. I'm a silver stacker, so that would really be fun. I'd probably go on a cruise around the world, and of course I don't know what $1,000 would buy at that time.
That would be the
question.
Might
be a loaf of bread. I don't know.
Well, I think...
but at least I'd be eating bread.
Yeah. Silver and gold would hold their value, at least. So we'd be able to buy the same amount that we can buy with it now. And that's really kind of the worst-case scenario, because you get a financial crisis that causes lots of capital to flow into these things, and their real value can go up for a time. It won't go up forever. 100 years from now, an ounce of gold will still buy a good man's suit, just like it bought a Roman toga 2,000 years ago. But in between there, you can have all kinds of fluctuations. And this could be a fluctuation to the upside where beyond just holding their value, gold and silver actually end up making you money in real terms. In other words, you can actually buy more with them than you can today. And so, it looks like it's going to be something that people will be happy they did somewhere out there. And it's just a question of timing, when you want to commit the most capital to it. But if you're stacking, if you're just buying something every month, doing dollar cost averaging, then you're okay. Because when the price goes down, you buy a little more. You're putting in the same amount of capital each time. And you eventually end up with a favorable price that looks great compared to where the price goes eventually.
And John, you've got a really good track record for making long-term housing predictions. Now, where do you think the housing market is headed from here? Maybe in the closer term and over the next couple of years, and then where do you think it's going to be long-term, 10, 20 years out? I'm
glad you put the long-term qualifier in there, because my short-term predictions tend to be horrendous. I'm always too early.
But that's better than being too late.
Yeah, but but being too early with leverage, which is what a lot of people have done over the last few years, is incredibly dangerous. It's really
But you didn't tell them to do that.
No, I didn't. But you get excited about an idea, and it's easy to use margin or buy options or something like that, and you really want to avoid that, especially in times like this when the timing of this stuff is so unpredictable. But anyhow, with housing, there are basically two factors. One is that a house is a real asset, which will tend to be, about the same utility 1 year to the next. It's a place you live. It's a consumable that's going to give you the same value over time. And so if the dollar goes down in value, you would think nominally. In other words, the dollar value of most houses would go up. So a house could be a good value in dollar terms, could be a good investment compared to a bank account or something like that. But at the same time, most real estate is leveraged. Most people borrow money to buy a house or an office building or a shopping mall or whatever. And so leveraged financial assets or leveraged assets tend to be really volatile and risky. So in a financial crisis that leads to a slowdown in the economy, you could see a plunge in house prices and in real estate prices in general. And so that's the big risk out there, is if we have another recession, we're 5 years into a recovery. That's when you usually get another recession. And real estate prices tend to go down for a few years during recessions, especially steep ones. The last one, the average home price went down by 20 or 30%, depending on where you were. And if you've borrowed money to buy your house, you put down 20% and the house drops by 20%, you lose the entire investment that you put into that house. Your down payment has effectively been wiped out. And so that's the risk with real estate today. So it really depends on how the financial crisis plays out. Are we going to drop into a deflationary crash in which we wipe out all this debt through default? That's bad for real estate. Are we going to slide into an inflationary spiral in which we destroy our currency? That's pretty good for real estate. So, the currency crisis scenario in which we devalue the dollar by 80% against gold and go back to the gold standard, if you've taken out the biggest possible mortgage today, that's good for you because the dollar value of your mortgage just went way down. But that assumes that governments don't come in and rewrite the mortgage contracts to bring them into line with the devalued currency. They could do that too. That has been done before. And so we can't expect contracts to be sacred in a world where everything's spinning out of control. So you have a lot to think about when you're thinking about real estate, because do you want to leverage it or not? And do you want to wait for prices to come down and then buy something out of a bank's balance sheet when they have to take defaulted mortgages and take the houses back, things like that? Or there's a lot to think about. But I think if you're just looking at a house, which you're going to live in, and that's where your family's going to be, and you're going to spend 20 years there because that's your home, well, then don't worry about the price. Just do that, Find a community you want to live in and buy a nice little house. Don't buy too much, but make yourself a home. And then don't think of it as an investment. Think of it as building a safe home in which your kids can grow up, in which you've got neighbors that you like, in which you're part of a community. And then do other investing related things with the rest of your capital.
And can you give us one good tip from your new book, The Money Bubble?
Well, we've covered quite a few of the tips that are in The Money Bubble. But one thing I'll tell you, if you get excited about the prospect of these big financial changes and you want to make an aggressive bet, you're going to find all of these leveraged ETFs out there. Those are exchange-traded funds, which create portfolios of futures contracts and options to mimic the movement of a given market. So you can get something that will go up 3 times as fast as the S&P 500 goes down. So if you think the stock market's going to go down, you see these ETFs out there, you might be tempted to invest in one. Don't. That is one really important piece of advice. Those things are structured to bleed value over time. Without going into the technical details of why that's so, it is so. So if you buy one and you think you're going to hold it for 3 years and hope that in that time the stock market goes your way, well, if the stock market just sits there for 3 years, you're going to bleed value. You will lose value year after year in those ETFs. So do not buy those things and think that you're making a stable bet without any kind of a time pressure against the stock market. And if you do want to use them to make a bet, then this might be a little too technical for some of the people listening, but I bet a lot of them get it. You short those things. You sell one of those ETFs without owning it in the first place. And in that way, the propensity of those things to bleed value works in your favor. So I'm sorry if that was too confusing, but play it over a couple of times and then look up how that works. And it's a really interesting strategy for using these new financial instruments, which are actually not favorable for individual investors, and making them favorable for you.
And we'll have links to buy the Money Bubble in today's show notes. But John, can you remind folks where they can find your website?
Sure. I run dollarclass.com, which is a continuously updated site that covers a lot of the stuff we talked about today. And it's got a big ad for the Money Bubble on there, too. So you can go there and buy it on Amazon via dollarclass.com.
John, thanks again for taking time to come on the show.
Thanks, Mark. Enjoyed it. Today's
Prepper Recon Top 10 list is Top 10 Ways to Tick Off the Government. Number 10, vote for a third-party candidate. Number 9, store more than 3 days' worth of food. Number 8, buy a gun. Number 7, memorize the Constitution and Bill of Rights. Number 6, pay for stuff with cash. Number 5, pay for stuff with silver. Number 4, barter. Number 3, turn off your cable. Number 2, homeschool your kids. And the number 1 way to tick off the government is to buy the new book by David Kobler and Mark Goodwin, Retreat Security and Small Unit Tactics.